ratio can be found by dividing a company's total current assets by its total current liabilities. A company with a current ratio of between 1.2 and 2 is typically considered good. The higher the current ratio, the more liquid a company is. However, if the current ratio is too high, above 2, for example, it might be that the company is unable to use its current assets sufficiently. Calculate profit margin ratio by subtracting total expenses from total revenue, and then dividing this number by total expenses. The formula is total revenue minus total expenses, divided total revenue. Profit margin ratio is shown as a percentage. Other names for profit margin are profit margin ratio, gross profit ratio and sales ratio. Your profit margin can tell you how well your business performs compared to other market players in your industry. Although there's no magic number, a good profit margin will typically fall between 5% and 10%. Below, we've compiled the net profit margins for common small business sectors. In essence, the company isn't generating strong sales prices relative to their cost of goods sold. Return on equity ratio is equal to net income divided by shareholders' equity. To get a percentage when calculating ROE, multiply your total by 100. You can find net income on your income statement. To calculate net income, subtract expenses and cost of goods sold from your revenue. 25% would certainly be a very good return on equity. Anything over 15% is generally seen as good. If a company has a high return on equity, they are increasing their ability to make a profit without needing as much money to do so. If a company has a lower return on equity, then the opposite can be said. Debt-to-equity ratio formula is calculated by dividing a company's total liabilities by shareholders' equity, which can be found on the income statement. Normal debt levels can vary, but a debt-to-EBITDA ratio above the 4 to 5 range is typically considered high. A good debt-to-equity ratio is typically considered to be between 1.0 and 1.5. A debt-to-equity ratio of 2.0 or higher is considered risky. A negative debt-to-equity ratio means that the company is on the verge of possibly going bankrupt.